Federal Reserve Chair Jerome Powell stated on Tuesday that similar data in the months ahead may necessitate an even more pronounced increase in rates than anticipated. Powell cited last week's strong jobs report as evidence of why officials expect to approve additional interest rate hikes to control inflation. Powell said at a discussion at the Economic Club of Washington, D.C., "It kind of shows you why we think this is a process that will take a significant amount of time. I think it underlines the point that we still have a long way to go to bring inflation down to 2%, the author says. Last week, the Fed increased its benchmark short-term interest rate by a quarter percentage point to a range of 4.5% to 4.75%, and Powell predicted that there would likely be a couple more similar increases, in line with the December prediction made by the Fed. That would raise the rate from almost zero in March to a range of 5% to 5.25%, capping the most ferocious wave of rate increases in 4 decades. However, the financial markets had already factored in a single further quarter-point hike. While a higher jump was also possible if inflation proved to be more difficult to control, Powell said it was only likely if it decreased more quickly than anticipated. But on Friday, the Labor Department announced that companies had created 517,000 new jobs in January, after payroll growth had fallen to under 300,000 over the previous 3 months of 2022 from over 400,000. The unemployment rate decreased to 3.4%, a 54-year low. Since then, Treasury rates have increased while the Standard & Poor's 500 index has decreased. Markets currently anticipate 2 additional quarter-point rate increases. Financial circumstances are more in line with Fed rate predictions than they were before the labor market report, Powell said. He did mention that the Fed's goal is to reduce inflation, not to constrain the labor market. He stated, "What we're attempting to do is get inflation down. The unemployment rate is not what we're aiming for." Powell recognized that there was a significant decline in inflation last year, and Fed officials anticipate more of the same in 2023. Declining from 7.1% in November and a 40-year peak of 9.1% in June, consumer prices increased by 6.5% yearly in December.